Welcome everyone, and thank you for joining us for this tax planning webinar. My name is Dermot Reiter. I'm a senior financial advisor here at Willis Partners, and joining me today is Paul Barbara, who's a director at Willis Partners. Paul is
Hello,
a
everybody.
highly experienced chartered accountant and business advisor who works with high-income professionals, business owners, and family groups, and he looks after a whole host of things, but tax structuring, compliance, and longer term planning is his bread and butter. So he brings really valuable insights into what actually matters when it comes to compliance structuring and proactive tax planning. And we're very fortunate to have him share his insights with us today. So welcome, Paul.
Thanks very much for having me, Dermot.
And just a general reminder that what we cover today is not personal advice. It's general in nature, so it should not be taken as a recommendation. So if there's anything specific you want to get into, obviously that's where you need that conversation with your advisor and or your accountant. So just keep that in mind. General housekeeping before we get underway. If you have any questions throughout today's session, please use the Q&A box in your Zoom menu that you can see below and submit a question at any time. We'll get to a few questions at the end, and a recording will also be made available after today's event if you want to send it around or watch it again. So with that, we'll get into the agenda of what we're looking to cover today. And what we really want to explore today is tangible strategies to effectively retain more of what you're earning, how to make the most of superannuation, how to maximise eligible deductions in a compliant way. We also want to look at how to use tax structures to manage income and investments more efficiently. Then we'll highlight some common traps and ATO red flags. The ATO is looking at some of these tax planning strategies with a lot more focus than previous years. So there's some risks there that need to be thought through, and we'll take a few questions at the end. So beyond that, get into superannuation, and super really is your primary tax shelter. So if you're paying the top marginal tax rate, which is currently 47%, every dollar that you put into super within the caps is effectively a mini tax arbitrage. So you're swapping a 40% tax rate in your own name for 15% inside super. So this is, what financial planners refer to as the no-brainer or the low-hanging fruit, making the most of what's called your concessional contributions. So this is where you can, in a pre-tax sense, contribute up to $30,000 per annum per person. And that includes employer contributions, salary sacrifice, and other personal deductible contributions as well. So when these contributions are made into your super, they're taxed at 15% instead of your marginal tax rate. So particularly for salary sacrifice and personal deductible contributions above your employer contributions, there's effectively a 32% tax saving relative to the top marginal tax rate. So this is something that a lot of high income earners just have to routinely, in a disciplined way, do every year. Now, a few years ago, there was an interesting rule change in super that enabled people with balances under $500,000 to take advantage of unused concessional contributions from prior years. So, Paul, this is something that we see a lot of high income earners often miss. But can you just walk us through how the catch-up concessional contributions work for high income professionals?
Absolutely. So essentially, you've got effectively a 5-year catch-up on any unused concessional contributions that haven't been, I guess, utilised through those years. So as an example, and obviously the caps of which obviously changed over those years, and they've sort of gone from 25 to 27.5, and at the moment 30,000. So the idea would be that if, say in the 2021 financial year, that if you had not used your full concessional cap in that year, you can do a catch-up and contribute those additional contributions in the current financial year that you're in now. So on top of the 30,000 that you have available to you in the current year itself. So it's quite powerful. It can obviously significantly reduce your personal income tax position in the current year. And it is missed a lot. Your accountant generally has access to that information very quickly through the ATO portal, being a registered agent. So the information can be readily available for you within a couple of seconds to see how much you actually have available to you. So it is missed quite a bit. Obviously, you've got to have the funds available to actually make that contribution. So that's where your financial planner comes in. But it's definitely something that's missed quite a bit. And as we talk about low hanging fruit, it is definitely a low hanging fruit item where you can easily then save that difference of 32 cents on the dollar by making those additional contributions.
Yeah, yeah, good point. I think just on that as well, that $500,000 super limit that I referred to before, that's as at the prior 30 June. So your super
Correct.
balance, if that was under 500,000 as at 30 June 2025 for the current financial year, even if your
Yep.
super balance is above that as it stands today, you still
Correct.
may be able to do that. The other thing I think is a important point is that it's a rolling 5 years, isn't it, Paul? So
Correct.
effectively,
That's right.
post 30 June 2026, the cap back in the 2020 financial year, or 2021 financial year, I should say, was
Yeah.
25,000 back then. So
Correct.
if you hadn't have used that cap post 30 June 2026, you won't be able to use that unused amount because the rolling
That's
five
right.
years will move to the next 5 year period. So it's just something to be aware of. Work with your accountant, see if there's any carryover amounts that you can utilize. And the other
Yeah.
thing with that is that you have to go over the $30,000 cap for the current year to utilize those prior year amounts. So effectively, yeah, you've got to go over the current cap amount to get access to those unused amounts.
Yeah,
So
just sorry if I just jump in, Dermot, as
yeah,
well.
sure.
It's a couple points. With one, you already touched on earlier, ensuring that you look at obviously your super guarantee contributions that are made from your employment income. They obviously
Mm,
go towards that cap. And the second thing is just obviously, we might have some viewers that have an SMSF, and they've obviously, might be a husband and wife or partners that are in the fund, and understanding that the cap relates to your individual balances, not the
yep.
total super fund as a whole. So if you're combined over 500,000, you still might be able to, because you might be at 300,000 on one of one partner and 200,000 another. You are able to access those catch-up contributions.
Absolutely. I think the other call out here, and we'll touch on some of the financial planning aspects surrounding this, but it's not just the tax saving on the monies going in, but it's the compounding effect in superannuation. So through longer term modeling, we find that when those monies go into super and they're only subject to 15% tax on the underlying earnings of the assets that we're investing in, the compounding effect is just so much greater compared to investing in your own name, where effectively you're losing 47 cents in the dollar on every dividend and interest and rent payment from the underlying investments. So I think with that, one of the other aspects, Paul, that we do see, and it catches high income professionals by surprise, is this Division 293 tax. And there's lots of technical terminology, but essentially there's an additional 15% tax on concessional contributions once your taxable income plus concessional contributions exceeds the $250,000 threshold. So how do
Right.
you think and go about planning around this for clients?
Yeah, well, one of the things probably to start with is obviously the calculation of that taxable income, as you've alluded to. It's obviously your gross salary income, and any other income that you have, plus the actual contributions the concessional contributions that you've made. But also, given we're talking about high net worth, or high income earning professionals, things such as reportable fringe benefits get added back on into the calculation as well. So if you've got a salary packaged vehicle, for example, or any of those type of items that you may be able to package up through your employer. Even net rental losses, if you've got a rental property in your name and you've got a net loss through that year. So that adjusted taxable income, or that Division 293 income calculation, can very quickly get to that 250 without you even
Mm.
noticing it. So it's very important, obviously, again, to speak to your accountant or advisor to ensure, before you get to the end of the financial year, to see, okay, am I actually approaching that limit? But I guess, we sort of then need to balance up and say, well, okay, if I'm making a concessional contribution in addition and using that 30 grand cap that we talked about earlier, is it actually the right strategy, given we're going to be paying that extra tax on that super contribution if we make that? So it's important to speak to your advisor, as we'll say a few times through today, but
Mm.
to ensure that you are working out and saying, okay, well, am I better off paying that additional 15% tax? Does it actually give me a better tax benefit than on the other side? So that's probably the key point there. And noting too that if you do go over that cap and, that limit, and do actually have to pay the additional 15% tax, that you're still only being, well, I shouldn't say only, but you are being taxed at 30%, which generally, if you're in the top marginal tax bracket, is obviously still better than paying 47%. So probably those couple of points probably key there.
Yeah, so it's still a benefit even if you are way over that cap. There's not
Correct.
much you can do
Yeah.
about it, but yeah,
Yeah.
it's just not as attractive. And
Yeah.
if you're around that limit, there's a bit more nuance and planning to
Yeah.
tilt things to your advantage. So
Yeah.
in terms of non-concessional contributions, so these are contributions that you make in an after-tax sense. So these are monies you've already earned, paid tax on, sitting in your bank account. Now, the limit for that at the moment is $120,000 per annum per person. And there's the ability to use what's called the 3-year bring forward rule, where you can contribute up to 3 years worth of that $120,000 allotment or $360,000 per triennium in one go. So these contributions are a really good way to build up your super very quickly, particularly attractive for those in their 50s and 60s that have a clear retirement timeframe and have strong liquidity outside super. Now, the nuance which we'll get into around the timing of those contributions is that there is a limit on when you can make those contributions, because if your super balance is $2 million or above, you're precluded from making these non-concessional contributions. But if you're just under, there might be some opportunity to do those contributions. So again, this is the time frame around how much you load up on super and in what stage of life and what are your other competing needs and liquidity objectives. And it's really important to get that planning and some of the projections that support that in place. So in that regard, there's also, and a lot of people might be aware, there's been some recent changes to superannuation tax law, and it keeps us very busy in terms of how to navigate those rules and get our clients to take advantage of the rules, even with what we're seeing at the moment around what's called the Division 296 tax, which is due to apply to those with super balances above $3 million at the end of a financial year. So in a basic sense, this is tax on top of the usual 15% tax that you're funded already be paying on the underlying earnings in the accumulation phase. So the proportion of earnings linked to the part of your balance over $3 million and up to $10 million are now effectively taxed at 30%, whereas previously it was 15%. And the earnings that are linked to, sorry, in a proportional sense, above $10 million super balances are taxed at 40%. So whilst the $3 million and $10 million thresholds are indexed through time, which is a welcome change to the updated legislation, many high income professionals are on a trajectory where this tax is going to affect them in 10 to 20 years' time. And this is the importance of modelling some of these outcomes to know the trade-offs that underlie them, and in terms of how to maximise contributions over what time frame. So because you can't withdraw super early to sort of duck under the threshold if you're getting close to the cap, some of those larger non-concessional contributions that I referred to before, they need to be really weighed carefully against the future tax liability under this new regime, and balancing that out with the flexibility that you might need and access to funds before retirement. So it's really important that you talk to your advisor and your accountant to sort of model what that path looks like, because up until these rule changes, the common strategy with financial advisors was just max super contributions for as quickly and as young as possible, and then just let that accumulation effect in a low tax environment go. But we need to be a lot more nuanced now. So Paul, how are you approaching this new Division 296 tax with clients, and what are you seeing?
Yeah, look, a lot of it is around now, as you've already said, the old playbook about, just dumping as much money into super as you can because it's the best taxed environment, has changed now to more of finding the most tax efficient combination between super and non-super, wealth. And given your age, your income, your goals, what your future plans are with regards to holidays or whatever it might be, and ensuring that you've got that right mix, as you've said. Now, from a tax perspective, and we'll talk about the structures a little bit later on, but whether then you do have a family trust that you invest via, and potentially a corporate beneficiary that you can distribute to, they have their pros and cons as well. But it's really now an overarching discussion, and it's not as simple as just, yes, put as much into super as you can.
Yeah.
Yeah.
And in relation to the deductions that you're entitled to claim to improve your after-tax outcomes, we might just get to that because this is a really important consideration. Paul, can you walk us through what makes a deduction legitimate?
Yeah, absolutely. So there's three main, primary tests or things you need to look at. So obviously, first one being, have you actually incurred the expense? So have you actually pay for the expense or expense the money to actually claim that deduction. Next one is there's going to be a nexus. So there's going to be a connection with that expense and you actually earning your income. So it's the old Section 8-1, as they call it in the Income Tax Assessment Act, but I won't get too technical with that stuff. But essentially, yeah, there needs to be a connection between the income you're earning and the expense you're incurring. And the third one, which is a big one, which is always comes up whenever you have an audit event, is what substantiation do you have to prove that deduction, whether it's receipts, whether it's logbooks, etc. So they're the main areas of how to make it legitimate. And every deduction or every type of deduction has a different way of proving that legitimacy.
Yeah. And Paul, what are the typical types of deductions that professionals can claim?
Yep. Well, we've got a few there on the screen. So obviously professional memberships and registrations, myself being an accountant, claiming my chartered accountancy accreditation each year, those fees and CPD points, anything to do with your professional development or professional memberships can be claimed. Again, ensuring you've got tax invoice or the receipts to prove those expenses and be able to substantiate them. Another one is self-education. So you've obviously, a lot of people obviously do continual training and development through their work life. As Dermot and I know all too well. So obviously, training sessions, conferences, anything that goes towards your CPD points and directly attributes to your learning and development in your employment. They're obviously a critical one, and I think it gets missed quite a bit, to be honest. And I think a key point with self-education I find with a lot of professionals is that a lot of the time those costs are actually paid by the employer. So obviously you can't claim that again unless you're physically paying for it. So that's probably one I see quite a bit. Tools of trade. I mean, we're talking about laptops and phones and tablets and those sort of things, and looking at the apportionment of the use of those assets too, and then how do you substantiate that percentage of use for work purposes versus private purposes. We all know that, we get a laptop from work, but we obviously use it for private purposes, maybe at home to watch Netflix or whatever it might be. So just understanding those differences in private use versus work use. So they're three of the, I guess, probably the main ones that we see for professionals. There's obviously a plethora of others, but they're probably the main three.
Yeah. And so these seem like they're easy wins when they are done properly and they've got the documentation to support them. But Paul, we know that professionals can get themselves into trouble, and the ATO is watching these areas very closely. So we know that there's really 4 red flags in terms of the broad areas where high income professionals can overclaim or under document. Where is the ATO actively focusing their compliance efforts? And can you just walk us where people go wrong in each of these areas?
Yeah, so we've got 4 there on the screen, and they're probably, look, every year there's a sort of a hot tip list that the ATO sends out of what they're targeting every year. So we get that update every year. But these are probably the 4 main ones, I guess, that come up quite regularly for professionals. So travel, and that might be both using your vehicle or public transport or taxis, Ubers, those sort of things. So one of the main mistakes is that traveling from home or your place of home to work and back is not counted in generally not counted as work use. It is traveling between workplaces generally that is considered deductible. So they've got an example there. If you're working, say, between 2 hospitals or between chambers and court if you're a lawyer, those are the deductible portions of your travel claims that can be claimed. And again, keeping logbooks, particularly with a motor vehicle of each travel or each movement, and understanding that what portion of those are business and what portion are personal. So again, your accountant generally can assist you with that, giving you a proper template, or you can buy a logbook from Australia Post, a little yellow book that's been around for many, many years. So that's one of the big ones that there are mistakes on. And the HO, and we've seen it with clients that have been audited in the past, which we don't have many who get audited, but when they do, that you're out by 1 kilometre and they actually disallow the logbook. So it's quite stringent.
Oh, really?
And I've seen it happen. So you've got to be spot on. they'll have a look at the good examples. They'll look at the fuel receipts and they say, well, your fuel receipt on the 1st of April 2026 was in Carlton, but your logbook says you were in Bentley. So how are you filling up petrol in one location, but you seem to be in another location? So they are very detailed, and I'll hazard a guess to say that the AI in the background that the ATO is using themselves picks up these things quite quickly. So travel's a big one. Working from home, obviously, flavour of the month, with everything that's happening in the world, especially over the last few years. So a couple different methods you can use there, and one is just the fixed rate method, which is just depending on the year, but 67 cents or 70 cents in the current financial year. And that covers then what we find is then the issue that happens is that is an all-encompassing claim. So you can't then go and then in addition claim for internet or for phone, etc. It's one number covers a lot in that respect. So that's one method. The other one is the actual cost method. So that's you actually keeping a detailed record of every single date, time that you are working from home, keeping a logbook, which needs to be kept for 4 weeks, and detailing every minute that you're working from home. So again, can be quite laborious to do that, and it can come up with stuff very quickly. We've seen people obviously miss deductions and have to repay tax because of that if they don't have the right records. So that's working from home. We talked about tools of trade and mixed use items. So again, having the right details and records about how much I'm using my laptop for work as opposed to home, and how you apportion those amounts. Again, can come up with stuff quite easily. There's a lot of data matching with regards to looking up credit card details to see if you actually purchased that asset versus if it is actually a work laptop. So again, Big Brother, the ATOs can see a lot more information these days. And then self-education. So it's usually the rule of thumb, obviously, is always that it needs to be obviously in connection with your current employment, or it gives you the ability to increase your earning capacity in your current employment. So, sometimes we see people trying to claim self-education for a course that they're trying to, which will enable them to maybe go find or move careers or change jobs. That is obviously not deductible in their current income earning capacity. So, so they're probably the 4 main ones. A couple others I jotted down. Uniforms always a tricky one. I guess if you work at a hospital and you've got a, let's say Mercy Health or a Monash Health polo on or whatever it might be, you may be able to claim it, but just a general suit that you and I wear, Dermot, unfortunately we can't claim. So which is unfortunate. But and the other one I just wanted to mention, which sort of ties in with insurance and financial planning, is income protection insurance. I'd hazard a guess to say a lot about high net worth professionals here would have some form of income protection. Now, some of them will have it inside of super, which then is dealt via super and not deductible personally, whereas others will have it outside of super and pay for that income protection insurance. So 2 main areas there are that, one, ensuring is it inside my super or is it outside my super, number one, to determine whether it's deductible personally. But 2, then recently in the last couple of years, the ATO or the insurance agencies now are required to present an annual certificate to show what portion of that insurance premium is actually tax deductible. So it's not the whole entire premium anymore. It's only a certain portion of it that they've been able to differentiate now. And that we find that people are still claiming the full amount instead of claiming the tax deductible amount. So I could go on about deductions and errors for days because we've seen many of them over 25 years. But those are probably some of the key ones, I think, for our viewers today.
Yeah, thanks, Paul. So the pattern here is pretty clear. If you've got a legitimate deductions, they are available to you, but the ATO expects proper records, a clear nexus to current income and honest apportionment, don't they? So they're the key call-outs there. So if we look beyond your tax return, now we'll look at the part that often matters most for high-income professionals, and that's the structure that you earn through. So, Paul, could you walk us through when professionals have structural options and when they may not?
Yes, absolutely. So a lot of professionals obviously fall under the personal exertion income realm, I guess we'll call it, where you're providing that it's your exertion, your effort, your advice, I guess, that you're providing is where the income is earned. And so personal exertion at the moment is actually quite a hot topic. The ATO is looking at people that may be trying to income split or siphon off, I guess, some of that income that they are earning from their personal exertion to a lower tax environment, whether it might be by distributing to a family member or actually paying tax under a company, for example, at 30% or 25%, depending on what their business rate is. So, yeah, personal exertion is a very hot topic at the moment. We're providing a lot of advice to clients just regarding that and how they get the AHS basically sort of set up a sort of red, yellow, and green zones in this personal exertion area, and ensuring that our clients are in the green zone as much as possible. Obviously, is the idea. So now, generally, that would mean a higher rate of tax, but given it's such a focus area at the moment, where it's definitely at the forefront for a lot of our staff and a lot of our clients and the accounting profession in general. So I think, again, we talked about, obviously it's from your personal exertion, it's from you actually doing the work. There is still ability to sometimes differentiate that income, and we probably won't go into too much detail on that today, but that's where you sort of need to speak to your accountant and say, okay, well, how do I differentiate those different income earning amounts or different income earning revenue streams that I might have within my own income earning capacity. A lot of this personal exertion is generally around a high performing individual or professional that may be running a business through a company, for example, or through a trust, as opposed to running as a sole trader. We know as a sole trader, automatically your taxes in your own name, but sometimes they'll might be advised, and it may be good advice or not good advice, but let's set up a company and run your business through that. But you're a one woman person in that business, and all the income is earned from you actually doing the work. So it's quite important to understand the difference. And as I said, I've said a couple of times already, it is very much a focus area at the moment. So if you do earn personal exertion income, definitely speak to your accountant or your tax agent and discuss that, and do that before 30 June. Don't wait till after 30 June and then you can't undo what's already been done. So probably the other structuring, we obviously talk trust and companies is a big one. We generally find a lot of high earning professionals will generally start looking at, or if they haven't already, looking at trusts and especially discretionary trusts when they've got a family group, and looking at earnings in those entities. Again, probably trying to stay away from the personal exertion side of things, because ultimately it gets attributed to yourself personally anyway, but more so your investment income, capital gains, obviously from selling those investments, and also then franked income, dividends, those sort of things that may be able to then strategize about where they might be able to be distributed to keep your tax at a lower rate, as opposed to paying 47%. So we have many clients over the years that earn good income from what they do, and say, well, okay, well, if I go and invest that income in my own name, I'm only going to pay a top marginal tax rate. How can I best differentiate that and put it into a separate entity? Maybe your partner doesn't work, or maybe your partner's on maternity leave and they can't work at the moment, and therefore that gives you the advantage to maybe distribute some of that passive income, we'll call it, to be able to then minimise tax across the family group. So definitely a still available strategy, which many people employ, and something to definitely, again, speak with your tax agent about, as to see if it actually applies to you.
Yeah, it's a good call out. So it seems to be that structure is about having the right entities for the right types of income streams, isn't it? I think at a high level, and making sure that the ATO sees these as commercially genuine, not just tax driven.
That's right.
It's an important differentiation.
Absolutely.
So, because we know that even with a good structure, we know that the timing can make or break your tax outcome in a given year. And I think this is a really important point, is that this is where technical planning meets the real world decisions that you've got before you, and whether you're selling a practice or realizing a big capital gain or timing partner distributions, if you've got that flexibility, the difference between getting the timing right and wrong can result in significantly different tax outcomes. So that's where that sort of planning with enough time is very important. So particularly for things like capital gains tax events, if you're selling a property, exiting a practice, or disposing of shares, these create large taxable income in a year that the contract is actually signed, not necessarily when you actually get the money. So if you're already having a high income year, either through a promotion or a big bonus or a vesting of equity, stacking a large capital gains tax event on top can push everything into the top marginal tax rate of 47%. So one strategy that we often look at is, if we can, consider spreading the sale across several financial years, or doing it in a year where your income might be lower. And for some high income professionals that work pretty hard, they sometimes want a sabbatical or a transition to part-time work or a career break of some description. So that's a good year to kind of trigger those events. And if the transaction is in the next few months or towards the end of the financial year, the difference of even a few weeks in terms of when you sign the contract can mean a full year's deferral and can create a very different tax outcome. So it's important to really just understand what are your options there and whether you can actually, use that timing to your advantage. And we touched on super contributions, which is the other low-hanging fruit, as I like to say, but that well-timed concessional contribution in the same year, and if you've got unused concessional amounts from prior years during that year in which you've incurred a large capital gain, can meaningfully reduce your tax liability. The only caveat to that is that the money's locked up in super until retirement, which at the moment's age 60 or beyond. So as we mentioned earlier, that $30,000 concessional contribution cap and checking whether you've got a total super balance under 500,000 as at 30 June of 2025, you might be able to avail yourself of those unused caps from prior years. So, Paul, can you walk us through how you think about using capital losses and what the ATO is watching out for when it comes to income splitting through trusts and companies and other structures?
Sure, absolutely. So from a capital loss point of view, obviously, any capital losses you may realise can be offset against your gross capital gains. As we I guess, discussed earlier, or as Dermot mentioned earlier, the timing of those losses can make a really big difference to your tax position. So, if you know that you've got a large capital gain event happening in the current financial year, it's important to have a look at, say, okay, what other investments do I have there that may have its capital loss that, once discussing with your financial advisor or your stockbroker, whoever it might be, might say, look, this asset isn't going to achieve much growth, potentially under our advice, potentially should look at selling that stock, for example. From a tax perspective, we'd say, well, it's obviously a benefit if that loss is realised in the same year as that large gain occurs, to obviously reduce the overall tax that you would be paying over in that financial year once your tax return is lodged. So I think it's just important understanding also then capital losses don't, you are able to then quarantine those losses if, for example, we realise the loss in the current financial year, but there's going to be a gain, say, in the 2027 financial year. Well, that loss you don't lose that loss. That loss can be then carried forward to next year, and you can then utilise offsetting that loss against the capital gain that you know is coming in the following year. So that's probably the main side there. Obviously, we don't want to fall into the trap of letting those losses go unused if you have discussed with your advisor that that asset may not be of any benefit to you moving forward, and hence realise that loss. The other thing would be just to ensure that they were genuine investment decisions. They're not just being done just for tax purposes. So obviously a lot of this people talk about washing sales and selling on 30 June and buying back on 1st of July. Just ensuring that you're not actively engaged in that type of wash sale. It's obviously going to be a legitimate investment decision that you're selling that stock or that asset or that property, and I guess the outcome of it may be that it does benefit you from a tax point of view. So that's probably from the capital loss point of view. Regarding income splitting, I think we sort of touched on this earlier, obviously with regards to personal exertion income, and that's where I guess a lot of this income splitting comes about, and also with regards to trust and trust distributions. And I guess depending on who we have maybe viewing today, you might have a family trust where you've got adult beneficiaries, and the old strategy was always cap out their distributions to get them up to the top, just under the top marginal tax bracket, even though they weren't receiving the adult beneficiary weren't even receiving those funds. The ATO is now actively, it's called Section 100A, they're actively viewing those arrangements and are saying, no, the whole purpose of that provision is to ensure that the person that's receiving the distribution is actually receiving the benefit of those funds. So we actively, around April, May of every year, we're discussing with our clients that have trusts. Okay, you have an adult beneficiary. Have you actually provided them with any funds throughout that year to help them put a deposit down for a house or buy a vehicle or help them with their rent or whatever it might be? And how does that enable us then to actually do a proper distribution or an eligible distribution to them, and effectively then minimise some of that tax of the funds that have actually been provided to them? So that's probably the main one at the moment that the ATO is definitely focusing on quite heavily, and ensuring those trust distribution minutes before 30 June are actually accurate and in line with what the distributions have actually occurred. Going back to the with regards to income splitting, obviously the personal exertion, as we touched on earlier, ensuring that the income that you're actually earning from your personal exertion is in your that does actually get a tax in your own personal name, and ensuring that I guess with this from the ATO's point of view, ensuring that that isn't being split off and then enjoying a better tax environment. So with the focus and the scrutiny obviously by the ATO in recent years, obviously to help fix the federal budget, obviously, where we are at the moment. It's obviously a key focus area for them, and they're throwing a lot more money at the audit areas of the ATO to find these arrangements and find these ideas that come up through various channels to try and income split. So it's quite an important point at the moment.
Yeah, absolutely. And it seems that the timing and structure together can be incredibly powerful, but only when they're done with the support of genuine commercial substance and the proper
Correct.
documentation to support that. So
Correct.
we're now going to step back from the technical and talk about how all of this connects to your goals, values, legacy intentions, and ultimately the life that you want to build. And this is where I think the role of the financial advisor is really important in just sort of what does this all mean? It's important to keep that perspective of where we're headed and what we're trying to achieve, because it's not just about paying less tax, but what are those tax savings going to enable in terms of what you want to achieve? So for high income professionals, we often see the questions that they come to us with is, when can I step back from full-time work? How do I fund private school fees without derailing my retirement plans? And can I take a career break without any financial stress? And so this is where we use modeling and projections to help look at tracking towards the progress towards your goals, stress testing different scenarios and assumptions, and understanding what rate of return you need from your investments to hit those targets. And this required rate of return then informs things like asset allocation and portfolio decisions, and ultimately the risk that we've got to take to reliably try and attain those returns. So that's a really big part of what we do. And I think the modeling and the projections for particularly younger clients that are looking at super and non-super and over sort of a 10 and 20-year time frame, it can be really powerful to understand those trade-offs. So another aspect is on the insurance side. So the ability to earn income from your expertise essentially is really your greatest asset. So protecting that income stream is absolutely crucial. And we see that so many professionals are so time poor that insurance often gets ignored when something goes wrong. And it's a really important thing to pay attention to. So tax-aware insurance planning in that context means that, as Paul alluded to before, making sure that your income protection policy is owned outside of super, where it can be claimed as personally deductible. And Paul said that not all of it can be claimed, but a significant proportion in a lot of instances. And ensuring that your life and total and permanent disablement cover are structured to maximize tax efficiency and align with your estate plan as well. So it's thinking about the next generation and making sure that the coverage matches your needs and stages of life. So this is where the regular, at least annual reviews of your insurance policies are really important, because as you get into your 50s and into your 60s, that the cover and the cost just really ramps up. But you might not need that level of cover. So it's about getting what is a reasonable cost to pay, what cover do you need, and making sure that is adaptive to your age and stage. So things like career and life milestones, this is where super and non-super structures work together to give you the flexibility at different life stages. So the key here really is designing contribution plan to match your timeline. So having too much in super too early means that you might not have access to the required funds. And then having too little in super means you're paying unnecessary tax potentially for decades. So really getting that balance right is very important and a big part of what we do as advisors. On the debt side, one of the most common questions we get from high income professionals is, should I pay down the mortgage or just invest the extra cash? Now, the answer isn't a simple black and white, but it does depend on comparing the after-tax returns. So at a high level, what we tell most people is paying down non-deductible debt, such as your home loan. It effectively gives you a guaranteed tax-free return equal to your interest rate. So if you're paying 6% on your mortgage, every dollar you pay off your mortgage is effectively a guaranteed rate of return of 6%, which is pretty good in today's current climate. And whereas investing gives you a variable return, which is obviously unknown, and the last events of the last 4 or 5 weeks has certainly been a good example of that. and it's taxed at your marginal tax rate if you're investing in your own name or via other structures. So you can claim things like franking credits or capital gains tax discount, but generally there's a tax impost associated with that, which needs to be understood, the net of tax outcome relative to paying off the mortgage. And things like deductible investment debt. So if you've got debt on a practice loan or an investment property, it means that the interest is tax deductible. So the real cost is actually lower when you consider that tax deductibility. So if you're paying 6% net of the top marginal tax rate, you're looking at about 3.2% is the net interest that you're actually effectively paying. So the priority for most people is a balanced approach that involves maintaining some liquidity, so not just paying all the debt down, but really prioritizing paying down the high cost non-deductible debt and then investing where there's risk adjusted returns that make sense in an after tax sense. And that comes down to the stage in the cycle that we're in and the asset allocation framework that we want to adopt. So it's really important that your accountant and your advisor are really across what your intentions are there in terms of debt strategy. Another thing that we see a lot of high income professionals look at is, for some people, they want to give back. So things like structured philanthropy can be a really good way to align those money values with your income in a tax effective way. So there's a couple of main options that you can avail yourself of here. You can either make regular donations to registered charities that are important to you, and they're often fully deductible at your marginal tax rate. Or if you want to have a little bit more sophisticated giving plan, you can establish your own foundation through what's called a private ancillary fund or a charitable trust, unique structures that you can set up. And these can be established to make large deductible contributions in a high income year. So if you're selling a business or selling an asset with a big gain, you can actually claim a tax deduction for that if those monies or a portion of those monies go into those structures. And then it gives you the ability to distribute to causes and charities through time. So it's more of a legacy intention where you're distributing those assets over many years rather than just in a single year. So, but I think what I'd highlight is beyond the tax benefit structuring you're giving, it also helps start an important conversation with the next generation about your money values and how they should think about the money that you've accumulated when they eventually inherit it. And this is a really important part of our role, is getting the family around the boardroom table and saying, this, we've worked really hard for these monies. What are the values that are attached to them? And how do we want to give back if that's important to you? So lean on your advisor to help facilitate those conversations and set the next generation up for success. And in that regard, intergenerational wealth is a big part of that as well. So tax planning really doesn't end with you. It extends to how wealth transfers to the next generation. And whilst Australia doesn't have death duties, at least yet, it might be on the cards in the years to come, but your estate plan really does need to consider things like super death benefits. So a lot of people are not aware that if super is not necessarily tax-free, if it's paid to adult children or other people that are not considered tax dependents, and there's a bit of a nuance there in terms of those definitions, but most adult children are not considered tax dependents. So there's a tax bill attached to them receiving your super in a lot of instances. And things like family trusts, companies, and other property holdings that might be owned jointly, they're often not dealt with via your will. And therefore, they need clear succession plans dealt with in their own right. So it's really important that there's some non-estate assets that are not necessarily dealt with via the will. So this is where you need to look at things holistically, and you need proper planning because the next generation can inherit wealth, but if they don't understand how to manage it tax effectively, then they're going to see a lot of tax leakage when they eventually inherit. And process of that education, that takes time. So you want to start that, early on if you can, and if it's appropriate to do so. So now for a reality check, these strategies only work if you stay off the ATO's radar. And Paul's alluded to the fact that the ATO is looking at a lot of these areas pretty intently. So what are the behaviours that the ATO are looking at, Paul? And the cost of getting it wrong, we know, can far outweigh some of the short-term tax savings. But what are the red flags that you're seeing across the industry, and how can professionals go about fixing some of these problems into the future?
Yep, absolutely. So I think the key really is just sorry, can you still hear me, Dermot?
Yeah, yeah.
Yeah, sorry, I thought my earphones fell out there. Yeah, obviously, high income professionals obviously a key focus at the moment, especially as we alluded to earlier regarding personal exertion income. There's a number of areas that they're focusing on. There was consistent theme over the years always regarding some main areas. So obviously overclaiming deductions, and that might be whether it might be claiming private expenses that should not be actually claimed when they're trying to treat them as business expenses or employment expenses. It could be like we talked about earlier, traveling to and from home and including that as a business expense, or employment expense. So there's a lot of data matching that's happening out there. So the over deduction or over claiming of deductions is one of the key areas, which has always been a focus. But I think we've seen the economy when there is a deficit or the federal budget is in the red, then there's a lot more focus on it. So ensuring that you've got again, as we said earlier, the right documentation, the logbooks filled out correctly, etc., that ensures that you don't have this overclaiming issue. Obviously, yeah, we talked about pouring into your documentation, even to do with if you're running a business through a company or if you're a sole trader, just ensuring that you've got the right accounting package, even whether it's Xero, MYB, and you're actually recording those deductions, retaining the actual physical record, i.e., the receipt or the invoice. And with all these programs that are available at the moment, you can scan them in and upload them. You don't have to have a big filing cabinet like we always used to have in the back in the days. So poor documentation is obviously another one. And as I think another example I gave earlier was regarding the logbook and being out by a kilometre or two, or being in a different location to where the actual receipts that you filled up petrol can bring it unstuck. So that's another one. Look, considering your super caps, obviously we talked about those concessional and non-concessional areas, and again, that's where your advisor comes in, whether it's your financial planner, from working out, okay, how much should you put into super from a financial planning point of view, but then the tax side of things, where someone like me would come in and say, well, obviously, what is the tax benefit if you do go over the cap? How does that impact you? Can it be reassigned from concessional to non-concessional if you haven't submitted a notice of intent as yet? Those sort of areas. And obviously, look, with Instagram, TikTok, all these so-called advisors out there or specialists. I can't tell you how many days of the week I receive a link to a TikTok and which I don't even have TikTok, but I can't even open the thing. But saying, oh, can I do this, or this looks like this person's not paying any tax. If it's too good to be true, it is. And a lot of these scams that's what they are. These schemes are scams, and I guess people that are trying to sort of bend or even break the rules and imparting them on other people to think that is normal, which it isn't. So there's significant penalties that are involved. Whether it's penalties, general interest charges, back payment of tax that was not paid, that should have been paid. I like to sleep at night and not go through those strategies. And if you end up working with me, don't send me a TikTok. So look, they're probably the main areas. There's obviously others that they're looking into, but just a recap, obviously, poor documentation, overclaiming deductions, income splitting, they're the key areas at the moment that the ATO is focusing on.
Yeah, there's certainly a lot of, let's say, creative interpretations of tax law that are out there. And I think this is really important to get a second opinion if you are aware or exposed to some of these things. You just want to check in to see whether it's possible or not, because there's a lot of promises of all of these tax savings, but I think increasingly, particularly with how sophisticated the ATO is in terms of the data matching that you referred to before, and their ability to look at data, I think just playing a straight bat these days is just the safer strategy increasingly.
I'll give you an example. I actually spoke to Dermot about this earlier today. I had an example that I heard about not so long ago that, obviously an individual had quite a low taxable income in their personal name in a specific year. The ATO was able to obtain the number of insurance policies that this person had from the insurance companies, and this person had 7 motor vehicle insurance policies, and they said, okay, well, how can you have 7 motor vehicle insurance policies? That's a lot of cars, but your taxable income is only $80,000 a year. It doesn't seem quite to balance, and just to go to show the data matching that the ATO can obtain. So quite a surprising one, I thought, but just shows the far-reaching ability they have now these days with data matching.
Yeah, absolutely. Got to be very careful. So with that, we'll now take a few questions from the audience. And whilst we're waiting for these to come through, one for Paul that is quite topical at the moment is with recent talk of changes to trust taxation, what should professionals be reviewing or changing now rather than waiting for the laws to change that you can see?
Yeah, absolutely. Obviously, Bendel's case, which some of you may have heard of, is obviously been a big topic in recent months, and there's obviously an appeal happening at the moment as well by the ATO. So, what we usually find in these cases is, if the I guess the person that's going up against the ATO wins, then the ATO will just change the law. So, I think that it's probably not a specific answer to this, but I guess it's all about with regards to trust. It is about how you're distributing that income, how you're splitting it with, say, a corporate beneficiary or an adult beneficiary, and are those funds actually being moved across? And that's where this Bendel case comes in. It talks about, well, the monies are retained within the trust, even though we are distributing, say, to a corporate beneficiary. If we're retaining them in the trust for investment purposes, well, then there should be no Division 7A issue, which we won't go into Division 7A. That's a whole other topic. But I think the key here is to ensure that you are proactive, not reactive. So speaking with your advisor, whether that's your tax agent, your accountant, your financial planner, looking at things, say, now as opposed to waiting until after 30 June and say, well, how can we change the structure if it's possible and it's not going to cost us anything from a tax point of view? What are the best ways to we talked about earlier, the mix between super and having investments inside of super versus outside of super. It's all those general topics. Obviously, they'll be very specific to the person that we're dealing with, but those are the things, again, the best piece of advice I can give is be proactive, don't be reactive. I think we have a lot of that in society, and our governments have proven over many years that there's always a reaction to things as opposed to being proactive about getting things right before they occur. So, I think it's probably the best answer I give without going too specific to. We'll have a lot of people that have specific questions, which I'm sure we'll be happy to help with individually.
Yeah, absolutely. Yeah, if there are more
Yeah.
specific questions that anyone on the call today has, feel free to reach out to myself or Paul, or your apt advisor, and we can address those specifically. So, one question that I'm getting a little bit, particularly around the most recent changes to superannuation, is that if I'm likely to cross the $3 million super balance in the next, say, 10 to 15 years, what should I be doing differently now with non-concessional contributions? And I think, look, the modelling that we've done is, and the government's very aware of this, is that even if you do go above $3 million, it's often still better to have the money in superannuation with the additional tax. And that's relative to owning the monies in a family trust or a corporate beneficiary or another structure where the tax rates are likely to still be higher. And the numbers that we're looking at, you need to have close to that $10 million in super where it really is worth thinking about taking out a large amount of money and putting into some of those alternative structures. But everyone's situation is different in that regard. So I think it comes back to the timing and getting the modeling done as well around when should I do those larger contributions. So I think for a lot of people, it's about maximizing the concessional contributions because that's a deductible amount you can do every year. And then it comes down to cash flow. So if you're thinking about retiring close to an age in which you can access super, then it's not so much of a consideration around, well, should I maximize super or not? Making those larger contributions often makes sense. But if you're looking to retire in your 40s and 50s because you've done really well, then that's where you need to think about things really differently and say, well, look, I'm going to need 10 years worth of investment capital outside super. So therefore, I need to have a more of a balanced approach. So I think, yeah, even with these recent changes, super's still the best tax vehicle to own your investment assets longer term and get that compounding effect in a low tax environment going. But there's definitely a lot more nuance that we need these days. So, Paul, another question we get, and you touched on this throughout today's presentation, but for employees who can't route their income through different entities, what structuring options are realistically still available to them to improve their overall tax position beyond what we might have covered already?
So, sorry, you cut out there initially, Dermot. So you're saying if they're an individual, they don't have other structures involved with their employment income, they're earning that income in their own name?
Yeah,
And
are there
what
any
other strategies?
structures,
Yeah.
any other options that they can avail themselves of, or not
No,
really?
not really, no. I mean, generally, if your employment income, the income needs to be earned through yourself. I guess you need to look at then, is that income, and I'll use a professional, for example, that might be an employee, but also then have maybe a part ownership in a business, own some shares in a company, for an operating company, for example. I think the key with that would be ensuring that when you are offered those assets or those shares or that investment, what's the best way to structure that from
Yeah.
day dot? Not changing it half, in a couple of years when you realise, gee, this business is quite successful. I'm actually receiving dividend income. We might might be taken over by a larger company. We're going to have a huge capital gain, a windfall. The key is being proactive, not reactive, getting that right structure set up from the start, and ensuring that that investment or that share is owned under, say, for example, a family trust. So that way, then we can utilise capital gains benefits and distributions that may be able to then minimise that tax and it not actually, it has nothing to do with income splitting, because it's obviously passive income coming via a dividend or a distribution. So more going back to the original question with regards to just the individual, the key really is just maximising those tax deductions. It might sound like a very basic answer, but I have many clients over many years come to me. They might be preparing their own tax return through the ATO themselves, and they say, look, I don't know whether I should go with an accountant and actually look at the deductions. And by the end of it, they've saved well over what the fees actually cost them to actually do the return. So I think leaning on a professional that understands it and does it every day, I think you'll find that benefit very quickly. So unfortunately, there's not a lot of strategies from an individual point of view, but if there are other avenues of revenue that you are receiving, whether it is via an investment in a business or whether it's passive income, I'd probably touch on that too quite closely as well. Let's say, for example, you are a high earning professional, and we talked about setting up maybe a family trust to earn that income. You want to invest it in something. It may not go into super quite yet because you're still quite young, and you want to maybe buy a bigger house or look towards paying for education for the kids. Do we set up a family trust and invest that extra money we have into a share portfolio or whatever it might be that App Wealth might advise. So that's probably the other thing, just ensuring that the income you're earning is in the right structure. Employment income you can't really avoid, but obviously other passive income you can have it elsewhere.
Yeah, that's a good call out. Yeah. So with that, I think the key takeaway from today's session, by integrating the tax and accounting expertise with that comprehensive financial planning, we typically see that we're able to deliver more holistic, tailored solutions that are reviewed more regularly, and they lead to better after-tax and wealth accumulation outcomes, and they give our clients the peace of mind that their affairs are in good order. So I'd say please reach out to your advisor, discuss your tax plan. Now's a really good time in the lead up to the end of the financial year to do that. And Paul, thank you for sharing your insights, and thank you to all who joined us today. We hope that you enjoyed the webinar. And if you have any questions, please contact us or your advisor to discuss further. Until then, bye for now.